Have you noticed that many wealthy families own some form of real estate? This is because real estate is not just an investment. For many high-income Californians, real estate can be a powerful tool for tax planning, diversification, and wealth preservation. But the tax benefits only work if you understand the details. The One Big Beautiful Bill brought back 100% bonus depreciation for qualifying property. So now, real estate tax strategies are everywhere again. Cost segregation, bonus depreciation, depreciation-driven paper losses, and using rental real estate to reduce taxable income for high-earning Californians. And yes, this strategy can be powerful, but if you are a high earner in California, there are a few important rules you need to understand first, and many people skip them. For full-time W-2 professionals, those losses may not actually offset your wages unless you meet specific requirements. California may not follow the same federal bonus depreciation treatment. And when you sell, depreciation recapture can quietly take back part of the benefit. So before you buy a rental property just for the tax deduction, understand these three things: how cost segregation actually works, whether your losses are usable, and what the exit could look like after the taxes. I've seen this not just in theory by reading articles or watching videos, but I have practical experience with this as a real estate investor myself in California. And the California angle is the part that surprised me the most. Hi, I'm Aaratee, founder of Aaratee Financial. I've spent more than 20 years at the intersection of finance and technology in Silicon Valley, including leadership roles at major tech companies and leading financial institutions. On this channel, I break down practical tax, investing, and wealth management topics for high-income Californians. Today, we're talking about real estate depreciation, one of the most discussed tax strategies for high earners who invest in real estate. But instead of only looking at the tax deduction, we're going to look at the full picture. Federal rules, California rules, passive loss rules, common mistakes, and exit planning. We will cover what cost segregation actually is and why bonus depreciation matters. The passive activity loss rules that many people miss. Two main pathways that can make rental losses useful against active W-2 or business income. Why California can produce a very different result from your federal tax return. How to plan for depreciation recapture and the exit. And finally, a simple framework to use before buying rental property for tax deduction. Let's talk about bonus depreciation and what cost segregation actually does. Cost segregation is an engineering-based study that breaks a real estate purchase into its components. Residential rental real estate is generally depreciated over 27.5 years, and commercial real estate is depreciated over 39 years. Land is not depreciable, but a property is not just land and building. It can also include appliances, fixtures, flooring, carpeting, lighting, and other site improvements. A cost segregation study identifies which parts of the property may qualify for shorter depreciation schedules, often 5-year, 7-year, or 15-year property. And once those components are identified for shorter lives, they may also qualify for bonus depreciation. With 100% bonus depreciation back in 2025, qualifying shorter life property may be deducted fully in year 1 for federal tax purposes. But here's an important distinction. You're not writing off the entire property. You're accelerating depreciation on specific components of the property. For example, you buy a $2 million rental property. After allocating 40% of the value to land, you have roughly $1.2 million of depreciable basis. A cost segregation study identifies $300,000 of shorter life components. With 100% bonus depreciation, you may be able to deduct that full $300,000 in year 1 for federal tax purposes. For a high-income Californian in the top federal bracket, this could potentially create a federal tax benefit of more than $100,000. This sounds powerful, and it can be. But a real estate paper loss does not automatically offset your W-2 income. So the important question is not, can I create a real estate paper loss? The better question is, can I use the real estate paper loss against my taxable W-2 income or business income this year? You can create a big real estate paper loss and still get no tax benefit from your W-2 income. Under the passive activity loss rules, rental real estate losses are passive by default. Passive losses can offset passive income, but they cannot offset W-2 wages or active business income unless specific requirements are met. So you could buy a rental property, complete a cost segregation study, and generate a large bonus depreciation deduction and still not reduce your current year tax bill from your job or business. Instead, the loss may sit on Form 8582 as suspended passive loss. That does not mean the loss is worthless. If you do not have enough passive income this year, then it may offset passive income in the future, or it may be released when you sell the property in a qualifying taxable transaction. But it may not create the W-2 tax benefit you expected this year. This is why high earners need to understand the difference between creating a loss and being able to use the loss to reduce taxes from active W-2 or business income. A real estate paper loss does not automatically reduce your W-2 income. But there are two common pathways high income earners look at when they want real estate losses to offset active income. The first pathway is real estate professional status. To qualify for rep status, there are two big requirements. The first requirement is that you spend more than 750 hours during the year in real property trades or businesses in which you materially participate. The second requirement is that you spend more than half of your total personal service time during the year in those real property trades or businesses. The second requirement is often the hard part. If you have a demanding full-time job, it can be very difficult to qualify personally. But for married couples filing jointly, only one spouse needs to qualify. So a common planning scenario is one spouse earns a high W-2 income and the other spouse substantially manages rental real estate and qualifies for reps. But this is not passive investing. That spouse actually needs to be involved in real estate work and potentially enjoy it. If the requirements are met and there is material participation, the rental losses may become non-passive and offset the active income on the joint return. The second pathway to use real estate paper loss to reduce your W-2 taxes is short-term rental material participation strategy. You do not need real estate professional status to use short-term losses against your W-2 income, but you do need to meet specific rules. If the average use of the property is 7 days or less, the activity may not be treated as passive rental activity. And if you materially participate, the loss may be non-passive even without rep status. This is why short-term rental strategy has become very popular among high earners with demanding full-time jobs. You don't have to leave your career to use this strategy, but you do actually have to do the work. Material participation means real involvement. This may include guest communication, pricing, vendor coordination, repairs, supplies, and operational support. If a full-service property manager is doing almost everything, it will be difficult to support material participation. And there are other practical challenges too. Not every property can legally operate as a short-term rental. Some HOAs restrict or prohibit short-term rentals. Some cities and counties require permits, local taxes, and other fees. So the strategy is not as simple as buying a rental, listing it on Airbnb, and taking a tax loss. So the question is not just, is this a short-term rental? The better question is, can I legally operate it, materially participate, and prove it to the IRS in case of audit? Bonus depreciation can create a huge federal tax deduction. But if you live in California, the state may not give you the same tax benefit. Now, this is the part Californians need to understand clearly. California state does not follow the same federal bonus depreciation rule. That means your federal and California tax results can look very different. In a previous example, you may deduct $300,000 at the federal level in year one. But California may allow only a much smaller deduction that year because California follows its own separate depreciation rules. So you may get a much larger federal tax benefit and still have a much bigger California tax bill than expected. This also means you need to maintain two separate depreciation schedules for the property, one for the federal tax and the other for the California tax. Over time, this will also create a different federal and California tax basis in the property. And this matters later when you sell, exchange, or transfer the property. For high-income Californians, this is why you cannot use a real estate depreciation strategy to reduce your W-2 income or business income using federal tax savings alone. Real estate bonus depreciation can reduce your federal taxes today. But before you celebrate, you need to understand what happens when you sell the property. Depreciation is valuable, but it is often tax deferral and not tax elimination. Every dollar of depreciation you claim reduces your tax basis, and lower basis can mean larger taxable gain when you sell. When you sell the property, prior depreciation may come back into the tax calculation. Real property depreciation is generally taxed as ordinary income at 25% at the federal level. Any additional gain may be taxed as capital gain. But here's a California issue. California does not have a lower long-term capital gain rate for individuals. So California may tax the gain at ordinary income tax rates. You generally have three broad exit paths after bonus depreciation. Sell the property and pay the taxes. Use a properly structured 1031 exchange to defer gain by rolling into another like-kind property. Or hold the property long-term, potentially until death, where under the current law, step-up in cost basis may eliminate built-in gain. The right answer depends on your property, cash flow, liquidity needs, estate plan, and your long-term goals. But the key point is a good tax plan thinks about the exit plan before the purchase. The tax deduction from real estate depreciation may look great on paper, but IRS may not let you use it against your W-2 income unless you meet specific rules and can prove it to them in case of audit. Here are 7 common mistakes people make with bonus depreciation. Thinking a paper loss automatically offsets W-2 income. Ignoring the passive activity rules. Relying on a short-term rental strategy without actually materially participating. Modeling the federal tax benefit but forgetting California. Skipping the depreciation recapture math. Using weak documentation. If you're relying on reps or short-term rental material participation, documentation is not optional. You need records that show what you did, when you did it, how much time you spent, and how the work relates to each property. This may include time logs, calendar entries, vendor communication, bookkeeping, and maintenance records. The IRS and California FTB may examine these claims closely in case of an audit. And finally, buying a property mainly for the tax benefit, even when the investment itself is not strong. This one is important. The tax benefit should support a good real estate investment. Tax should not be the only reason to buy the real estate property. Before you buy a real estate property, mainly for the tax deduction, ask yourself these 8 questions. Does this property qualify for meaningful bonus depreciation? Will the losses be passive or non-passive in my situation? Can I realistically meet real estate professional status or short-term rental material participation rules? If a property manager is doing most of the work, it may be hard to justify material participation. Can I document my position throughout the year? What can the California tax result actually look like? Are there any HOA restrictions, city permits required, or additional fees for short-term rental? What happens when I sell, exchange, or hold the property long-term? And finally, would I still buy this property if the tax benefits were delayed, limited, or suspended? Bonus depreciation and cost segregation can be powerful tools for high-income Californians, but they work the best when the investment, tax rules, documentation, cash flow, California treatment, and the exit plan all fit together. If you would not buy this property without the tax benefit is probably not enough reason to buy it. If you found this helpful, please subscribe for more videos on tax-efficient investing, tax planning, and cash management for high-income Californians. And if you want help to think through your own cash management, tax management, and portfolio management, you can learn more at our website aurateefinancial.com. Thank you for watching, and I'll see you in the next video.